All right, let's just jump right into it. There's a financial revolution happening, like right now, right under our noses. It's this moment where Wall Street's core engine is starting to run on blockchain rails. And honestly, the results are, well, they're staggering. And it all kicks off with this. I mean, forget what you know about the CME or NASDAQ for a second. We're talking about a DEX, a decentralized exchange that just saw this insane tidal wave of trading. And get this, it wasn't for some new meme coin. Nope, this was for crude oil. Let's just pause on that number for a second. $5 billion in one day on one decentralized platform. I mean, come on, that's not just noise. That is a massive, flashing red signal that something really fundamental is shifting under the surface of the financial world.
So to really get how wild this is, you've got to see this comparison. That $5 billion in oil futures, that's just one real-world asset derivative, by the way. It actually, for a moment, surpassed the entire trading volume for Ethereum perpetuals, the second biggest crypto asset in the world. And here's the kicker. This wasn't triggered by some crypto bull run. The reason this happened? Geopolitical tension in the Middle East. While the traditional markets were closed, traders just poured into the only game in town that was open 24/7, and that was the blockchain.
And this whole event, it points to the real revolution happening with what we call real-world assets, or RWAs. But here's the thing. It's probably not what you think it is, based on everything you've heard for the past couple of years. Yeah, so the old story, the one from like 2021 to now, was all about tokenization. Let's put a house on chain, or let's turn treasury bonds into tokens. That was the idea. But the new narrative, the one that's actually happening right now, is all about derivatization. This is where on-chain markets become this sort of liquidity spillover pool for traditional finance. They're just soaking up all this global demand when the old school markets are closed for the night. So what the heck is derivatization anyway? It's actually pretty simple. It just means you're creating financial contracts based on an asset's value without having to own the actual thing. So you're not buying a physical barrel of oil and trying to figure out where to store it. Now, you're buying a contract that just tracks the price of oil. And that's the magic that allows for these super fast, liquid, 24/7 markets. There's none of the friction that comes with physical ownership. And check this out. Here's the data to back it up. This isn't just some crypto thing happening in a bubble. The statistical correlation, the link between real-world geopolitical volatility and this on-chain trading, it's 0.73. Now, a perfect correlation would be a 1. So 0.73 is a really strong connection. This is basically statistical proof that when things get messy in the real world, traders are turning to these on-chain tools as serious, legitimate financial instruments. Okay, so let's dig into the evidence on the chain. We're going to walk through 4 different case studies that show exactly how this is playing out across totally different kinds of assets.
So let's go back to that crazy $5 billion day on Hyperliquid. Just 2 weeks before, trading was kind of sleepy, around $25 million a day. Then, boom, as tensions escalated in the real world, the volume jumped to 200 million. The next day, 807 million. And then, the peak, $5 billion. That is a 200x increase in just 3 days. Insane.
So what do we learn from this? Well, that 200x explosion, it wasn't a fluke. It was a direct response to a huge unmet need in the market. It basically proved the value of what you could call an availability premium. It's simple, right? When the main markets are closed for business, the one that's still open, it captures all the action. All right, case study number 2, stocks. And look at this number. This isn't a one-day spike. This is $1.6 billion in weekly trading volume on a platform called xStocks. That's every single week. So why is that a big deal? Well, for one, it's about time arbitrage. It means a trader in, say, Tokyo can react to news about a U.S. stock while the New York Stock Exchange is still dark. It's also democratizing access. You don't need a fancy U.S. brokerage account anymore. And just like with the oil, it's all about synthetic exposure. You're trading the price, not the actual stock certificate, which makes it fast, efficient, and, truly global. Okay, so we've talked about super liquid things like oil and stocks. Now let's do a complete 180 and talk about one of the least liquid assets out there, real estate. And this number, $200 billion, that's the total value of property in just one U.S. county that's getting its records put on the blockchain. This is a huge turning point, you guys. This isn't some tech startup playing around. This is a legitimate U.S. local government, Bergen County in New Jersey, actively doing this. And because it's a government doing it and it's such a massive scale, it basically creates a template, a framework that hundreds of other counties across the country can just copy and paste. This is how real foundational infrastructure gets built. Okay, but for our last case study, we need to talk about a potential pitfall, a bit of a warning sign. And it comes from the world of tokenized gold. Just look at this market share. One single product, Tether Gold, or XAUT, controls 71%, almost 3/4 of the entire market.
And this really highlights one of the big dangers here. Anytime you get one single company controlling that much of a market, you're introducing a massive centralization risk. Now, what happens when you combine that with some reports of people getting 20x leverage on this stuff? Well, you get a recipe for systemic risk. The whole thing becomes fragile. And you can bet this is exactly the kind of situation that gets regulators very, very interested.
Okay, so we've seen the evidence, we've looked at oil, stocks, real estate, and gold. The big question is, where is all this going? What does the future of this 24/7 market actually look like? Well, a path forward seems to be shaping up pretty clearly. Step 1, on-chain commodities become the new normal for after-hours trading. Step 2, tokenized stocks start to blur the lines between, say, the Tokyo and New York exchanges, eventually creating one single global stock market that never sleeps. Step 3, real estate tokenization goes from just digitizing records to actually creating derivatives on property values. And of course, step 4, those risks we just talked about. Yeah, they're definitely going to trigger some kind of regulatory response.
So, what's the bottom line here? What does all this actually mean for you? Let's cut through all the jargon and talk about the financial playbook for this new world. Okay, let's just lay out the key metrics, like a dashboard. You've got that extreme signal from the $5 billion Hyperliquid peak. You've got that super high geopolitical correlation. Then there's the landmark green light from the Bergen County project, right next to the yellow warning light of concentration risk in gold. These are the vital signs you need to be watching in this new ecosystem. The playbook from here is actually pretty straightforward, depending on who you are. If you're a trader, you should be looking at the volatility arbitrage opportunities, that gap between when traditional markets close and these on-chain markets are still roaring. If you're a builder, well, the race is on to build the infrastructure for the next wave of on-chain assets. We're talking oracles, exchanges, everything. And if you're a regulator, the challenge is to be proactive, to get ahead of these systemic risks before something blows up. And this right here is probably the most important thing to understand. That $5 billion in oil, that $1.6 billion in stocks, that $200 billion in property. This has stopped being about speculative crypto assets. This is traditional finance, Wall Street money, finding a new 24/7 set of rails to operate on. It's just faster, more efficient, and it's always on. So when you look at all this, it becomes pretty obvious. The question is no longer if blockchain can handle real-world assets. We are so far past that conversation. No, the real question, the one everyone should be asking, is whether the traditional financial system itself is ready for this competitor, a competitor that never, ever sleeps.